Sure.
All right. Hope you're doing well, everybody. I am here with the infamous, unmistakably incredible mortgage
Handsome.
professional, John, and handsome. Yeah, how could I leave that out? Silly me. I should have said that first.
You're good.
John Trama. John, thanks for being with me today because I have questions for you that I need answered, really for my clients, but I think this is going to be very helpful.
My pleasure, man. Good to see
All
you.
right. Yeah, you too. Hope you're doing well. You're good looking as ever, so at least that's just let that go for
You caught me on
all
a
right.
you caught me on a good day.
Come on, there's no bad days with you. All right. So here's basically what happened. I'll give you the rundown. I got multiple calls from a couple of clients over the last few days, and several of them are new home buyers. They bought in like the last 2 years, and they're concerned because their student loans are no longer in deferment.
Right.
One of them spoke to me and said, I have $200,000 worth of student loans that I have to pay. What should I do? Should I take out a HELOC? Now they know HELOC because I told them about that. So I'm happy about that. But they said, should I take out a HELOC to pay off these student loans? So now I'm just going to tell you the advice that I gave them with the caveat. I did say you have to speak to a mortgage person about this and maybe a financial advisor. I am not the authority on this, but here's the way I would go about it. And John, if I said something stupid or wrong, you just yell at me and it's fine.
I sure
Because
will.
thank you. I can take it. So what I asked them was, I think for me, if I was in a situation, if I was considering taking out a HELOC to pay off this debt, number one, I would know, homes have appreciated significantly over the last 2 years. So if you bought in 2021, there's a chance that your home is at least 80 to $100,000 higher than what it was when you bought it, just in value, just from what's happened in the market.
Yep.
Now, I would look at it and say, okay, well, what are the interest rates of my student loans? And what is the interest rate on my HELOC that I could potentially get? And how long is that HELOC interest rate locked in for? Now, if that HELOC rate is pretty low and the student loan interest rates are higher, I would consider consolidating my debt using a HELOC so I have a lower interest rate and hopefully a lower payment. Now, this person in this situation, actually, they have two loans. One was in like the 3.5% range, and the other one was, I believe, in the 8% range. Now, I don't know what the rates are in HELOCs, but is that bad advice?
No, I don't think so. I think you advised them correctly. It really just depends. I mean, it's a simple, as simple as, weighing each one of them out and seeing what's going to be more advantageous for them. I think back in the day when rates were lower, to use your home equity to pay off student loan debt if it had a higher interest rate, that's great advice. But like a 3.5% rate on a student loan by today's standards is a great rate and probably not worth consolidating into a home equity line, right? So maybe the 8% one possibly, but again, as to your point, Congress obviously passed the law preventing further extensions for these deferments as of October. So anybody who has been pre-approved prior definitely should make sure that they can qualify today, with those qualifications. And even if they're still in deferment by for whatever reason, every program has different criteria. So for example, like FHA, if you have a zero payment associated to that student loan, they will take a 0.5%. VA also does a 0.5%. But interesting with VA, if you can show that they're in deferment for more than 12 months, they will actually exclude that debt. Sony May, as you know, I'm a big fan of that loan program, is also a 0.5%. Then you have your traditional lending agencies, Fannie and Freddie. Oddly enough, they're not the same. Fannie Mae actually takes 1%, so that can be kind of steep. So if you had a $200,000 student loan, that could be a $2,000 a month payment, which would make it very difficult to qualify. However, we move over to the other agency like Freddie Mac, and they only use a 0.5%, so that's $1,000. So we kind of just have to look at what it's, what the banks are using as a qualifying rate if they are still in deferment, and what that would be associated to versus what they actually are paying, and then we take it from there. Some people have amassed great student loan debt but don't make a lot of money, right? So you can call up that loan servicer and talk about income-driven repayment plans. So you can get a significantly reduced monthly payment that could end up being less than what the banks are using to qualify at a half or a full percent, and then qualify that way. So it's just a really, again, understanding every situation is going to be different. So again, working it out with your client is just going to be, taking it one step at a time and seeing what ends up being better.
The income driven repayment plan, is that when the loan is taken out from your paycheck directly and paid, or money for the loan is taken out of your paycheck directly and paid towards the loan? Is that how that works? Or
No,
is that
so it's
something else?
really, yeah, no, so it's based on the income that you're earning. So what they're doing is, somebody who maybe is coming out of school and doesn't necessarily hit like their top pay immediately, and maybe, or maybe it's a state job and they're not making a lot of money, so what they're doing is they're saying, okay, well, based on your income, your limited income, we're not going to expect you to make $1,000 monthly payment because your income doesn't support it. So we're going to reduce that to something that's more manageable. Again, some state jobs that are given based on the loans that you have taken. If it's a civil job, they will forgive that over time, right? So there's different there's different criteria based on the type of job you've got, how much you're earning. So it's not so cut and dry, and I wouldn't just run to go consolidate student loans into your mortgage, especially in today's environment.
Okay. Yeah, that makes sense. I mean, this is, I feel like, a question that I'm going to start getting a lot. So one of the nuggets that I took from you is, if you're thinking about buying a home right now, you should definitely, and you have student loans, you should definitely speak with your mortgage professional to see where you stand with those loans and how it's going to affect possibly your debt to income. Is that correct?
Yeah, 100%. Yeah, especially if you just came off the heels of been pre-approved previously. You want to make sure that we are taking into account these student loans, and then you want to go through the different programs and see what is going to give you the best bet or the best advantage to secure the financing that you're looking for.
Okay. Well, it's good to know that there's ways around this if you're buying. So that's super helpful. Now, I want to ask you, just because I get a lot of questions all the time about HELOCs and home equity lines of credit. For those who don't know the term, we in the industry call them HELOCs because it's way easier, way less of a mouthful. But when it comes to a HELOC, can you just kind of walk me through, let's say I'm coming to you and I'm like, John, I'm interested in taking a line of credit out on my equity. How does that start and how does it work?
No different than any other type of mortgage that you would apply for. Obviously, it's all equity driven, of course. So the more equity you have, the better chance you have.
Okay.
I would say that the parameters are going to be a little bit more strict because when you're purchasing a home, you can maximize financing. You can get up to 95, 97%. When you do a HELOC, you may be capped out at 80, maybe 85.
Okay.
There may be still some lenders out there that may push to 90, but if you do, you're going to end up paying a premium for it. Essentially, what a HELOC is I always like to explain to people, it's like having a credit card against your house, right? It's a revolving account. You only get charged interest on the portion that you use, and very similar to a credit card, as you pay it down, you have that access to that credit. So it's a great tool to have, especially with interest rates on credit cards being as high as they are. It's a great tool to kind of consolidate and make things a little bit easier, and also just to have for emergency purposes. Even if you don't need it today, you don't know what's going to happen in the future, and when you do have that equity in there, it's a great an emergency blanket for you and your family.
I'm so glad that you use the same analogy that I do. That is actually exactly how I explain it to people when they ask me. I say it's basically like having a credit card with the credit being the equity in your home.
Yes.
So yeah, there's so many uses for a HELOC from what I've seen just in all of the real estate stuff that I've been involved with, and all the people that I listen to, from investors to families to everybody. There seems to be a lot of functionality for the HELOC, and it seems to be a very good option. And from what I'm gathering from what you're saying is you could open up a HELOC, let's say, you could open up a line of credit based on the equity of your home. And once you open it, it's open. And now from what I understand, John, maybe I'm wrong and maybe this isn't how your bank works, but some of the banks that I've heard from in the past, is there closing costs associated with the HELOC? Because I've heard yes and no. Then I've heard only if you close too soon. Like if you close the line of credit, then you have to pay them. So
Right.
can you tell me a little bit how that works?
Yeah, sure. So yeah, there's always closing costs, right? But to your point, a lot of times banks will say, "Hey, look, if you're going to take an initial draw, we're going to waive them."
Okay.
However, if you close it prematurely, because a lot of them have prepayment penalties,
Hmm.
unlike traditional mortgages in New York, we don't have prepayment penalties, but on HELOCs, if you close them within a 2 or 3 year period, they're going to want to recapture the costs that they took care of on your behalf. So that's kind of how it works. But for the most part, it's pretty marginal. It's not like purchasing a home and you're spending tens of thousands of dollars in closing costs for a home equity line of credit. Usually, you can get one for maybe a couple of $1,000s. Here, if you were to close it out early, your penalty might be a few $1,000s. But it could be a little bit skewed based on the size of the line of credit. So the larger one, maybe that could end up being a little bit more. But another great advantage of a HELOC is also if you are thinking about selling. If you are
I was getting a pad. I just want to show you this. I was getting a pad to write down so I don't forget what happens if you open it and you're selling, etc. Go and let's do the first scenario where you never use the HELOC. So let's just go with that scenario first.
if you don't ever use it, it just sits there, right? Just like a credit card. You may have an annual fee, but other than that, there's no juice running on it unless you use it. So, but I also love it because not only for emergency purposes, but if you have an itch to maybe buy, to sell and buy down the road, and if you are equity rich and cash poor, you can use that home equity line as a source of down payment to secure, go get into contract for the new house that you're looking to purchase. And then what you do is when you sell your home, then you pay off the primary and that secondary loan. So the longer you have it, the less likely you'll have to pay that prepayment penalty. But if you're doing it for the purpose of moving on, just know that you will be liable for a few $1,000s in fees. And all you have to do is just ask the lender that you speak with, what are the prepayment penalties based on the loan size that you're taking. So this way you're prepared and not surprised when you do sell.
Right. So, I mean, this is one of the most used strategies for investors, right? It's part of the Burr method where you buy a house, you rehab it, you start renting it, and then you refinance it.
Oh yeah,
And
yeah, yeah.
yeah, you pull the equity out and then you buy the next property with the difference. So you just got to make sure that you're buying a house where you could add value. And then you obviously have to do a lot of math involved to make sure that you don't lose on the equation. But that's a very typical buy and use the HELOC to purchase the next property. So it does work with sellers. But essentially, if you, let's say, took out a HELOC as a rainy day fund, never touched it, and a year from now something happens and you decide you need to sell your home and that HELOC's open, you might have to pay a prepayment penalty, worst case scenario, or might have to pay out those closing costs, where you probably already paid out the closing costs if you didn't take a sum, but you might have to pay a few $1,000s in a prepayment penalty, but that's about it. Now, obviously, the next scenario is you've taken out a HELOC. Let's say you took out $100,000 HELOC. You use 30,000 of it to put in a beautiful patio and something in your backyard. And now you go to sell. You obviously then have to pay the difference in that HELOC back when you sell. So if you have $10,000 remaining on your payment, that obviously comes out of your net when you sell, correct?
That's correct. Yeah, not the 100, just what you have outstanding. Absolutely. Yeah.
Right. Okay.
Yeah,
And then
and
they
this
close out the rest of the loan. Can the HELOC negatively affect your credit or your borrowing power for your next property if you have that line of credit open?
Yeah, I mean, it can mess with your debt ratios, of course, just like any debt would, right? I mean, if you're
Okay.
carrying a balance there, but if it's but if you're selling the home and that loan is going to be paid off, then no, it doesn't impact it, because just like your primary mortgage, that's also going to be satisfied at the term of sale. So that wouldn't have any impact on your ability to purchase. If you were going to retain the property, that's a different story.
Gotcha. Okay. All right, that's great information. That's why I want to talk to you about this.
Yeah, man. Yeah, and one last thing I'll share with home equity lines, because there are some there's some nuances that from lender to lender are a little bit different. So
Okay.
like, for example, I could close one in 5 days.
Wow. Okay.
Yeah, so you're not because it's all digital today. So
Okay.
if you're in a pinch and let's say you have a buyer that's not prepared financially or can't borrow the money, and that you're just ready to put the house on the market, and you don't want to wait 30 days for a traditional credit union to close on a home equity line, well, we can do it in 5 days.
Wow.
So there's that. But there's also like conversion features. So for example, if you took a larger line of credit out, let's say it was $100,000 and you ended up using 50, and then you realize, well, you know what, it's a revolving rate, so it's going to change as the prime does, and maybe you're not in a position to pay it off in a timely manner, so you're worried about rates fluctuating. You could actually convert that portion of that loan to a fixed portion, and then the other 50,000 can be used still as a revolving line of credit. So you could stabilize part of it and keep the other half of it revolving too. So there are some, like I said, some nuances with the different banks and what they offer. So it's just a matter of really kind of understanding what you're looking for out of it and then matching you accordingly.
Right. Yeah. I mean, I could see how that would be extremely useful. Going from even keeping that open when you're buying a new house and having, a $50,000 credit line to potentially, I mean, who knows what you're getting into when you buy a new house, right? Even if it's built in the last 15 years, there's probably going to be things that you come across the first month that you're in there, because I get those calls all the time, from the angry buyer, where all of a sudden something happens, and it's just unfortunately the nature of the beast, where no matter how great of a condition it is, no matter what the home inspector report said, you get into a house and something seems to go wrong right away, right? There's nothing you could do. I bought my house the day of my closing. My house was a complete flip. The day we were closing on my house, there was a complete flood in the basement foundation leak. Thankfully, we were at the closing table and I was able to negotiate a $5,000 credit from the seller right then and there. But not everybody gets that luck, and I don't either most of the time. That was one of the luckiest moments I ever had. But
a quick lesson in homeownership for sure.
Yeah, exactly. And then that didn't even cover the cost of what I needed to do. So in essence, having that line of credit open, which, the interest rates comparable to a credit card are minuscule, because you're talking about 25, 28% interest on a credit card, right? I mean, they're somewhere up in that range.
Yeah.
To a HELOC, it's going to be a third of that, a fourth of that, depending on, what you get and what rate you get. I'd much rather have that outstanding debt for things that I need to pay off than obviously doing it with a credit card.
Right. Yeah. So currently Prime's sitting about 8.5. So yeah, some banks will offer some teasers, introductory rates. It could be Prime -1 for the first 12 months, Prime minus a half, and then Prime after. Some, depending on your credit, depending on your loan to value, you could be Prime plus something. So very easily could you be, in the double digits. But again, it's much better than the alternative, which to your point, credit cards could be in the 20s. So, it's definitely a smarter approach. If you're going to carry debt, I'd rather see you do it using your home equity than paying the credit cards that don't ever seem to go anywhere.
Yeah. I mean, and just to your point, it's another reason why home ownership is so much more valuable than, say, renting, because you don't have this option if you're renting.
Very true. Very true.
Now, how often does the rate change with the HELOC? Like, how often will we see a fluctuation in the interest rate?
As often as the Feds meet, and you'll hear about it. When the Feds say that we're raising rates, that's typically when your rate is being adjusted. So usually every quarter. And it doesn't.
Okay.
Yeah, and it doesn't move all the time. I mean, what I'll do is I'll send you a chart of the history of the prime rate, just so you can see that, maybe post that up on here. But it doesn't always change. Sometimes, it can go a year without it changing, and just as it can go up, it can also go down. So right now it's a little bit more of a volatile market, and right now it's a little dicey because they've been raising it steadily for the last year. But eventually that'll change, and it'll start going in the opposite direction. But usually you don't see more than a 0.5% adjustment at a time. I haven't seen one in a long time. So usually they do them in quarters to, I would say, at most a half at a time.
Okay. So yeah, so you're not going to wake up one day and all of a sudden it's 4% higher. Even so, like, you're talking about smaller amounts of debt. You might owe 10,000. So going from 8 to 12% on $10,000 on a HELOC isn't necessarily going to kill you.
It's not
Uh,
right. It's not going to crush you. No,
right.
definitely not. And again, it's also interest only. So, it's very similar to a credit card. I mean, if you want to pay just your finance charges, it's not taking away your principal of what you owe, but, it does allow you to have, that freedom of just making the minimum payment to keep yourself afloat. And the same thing with the HELOC too. You have that ability. And then the other piece of it too, like the other, I always try to tell people, like if you have money sitting in a small interest bearing account that's earning relatively no money, there's no point in keeping it there. Just take that money, put it into the HELOC, so you're paying less interest. And if you ever needed that money at a later time, you can always draw back on it, right? So there's always different ways to look at it. It's just a matter, again, always figuring out what makes more sense for your client.
Yeah. Yeah. No, I mean, I suffer from that that thought process all the time. Having money sitting in a bank account that's not doing anything, as opposed to what you can do with it to kind of amplify that money. Now, I'm going to ask you two more questions. The first one being, do you recommend for your clients, do you recommend a HELOC for someone who's owned a home for, let's say, a certain amount of time, just to open one as a rainy day fund? Do you think that that has use, or do you feel it's something that you should just do when you need it because you could close it so fast or open it so fast?
I would definitely go out and get one. There's no downside, to doing it. I mean, if you're getting it for free, right? Because they're deferring costs and you're not moving. So now you know that you're not going to have costs on the backside of it. There's no downside. Again, every lender is going to be different, right? Some may say to you they require an initial draw. And you have to maintain that draw for a certain period of time.
Okay.
Some might say, well, we need the draw, but there's no length of time that you need to keep it. So you take out the initial draw, and then in the following month you write the check back for the 25,000 or whatever it was, and there's no harm, no foul, right? So
Okay.
it's just doing your research and finding out which one's best. And for me personally, who's been doing loans for over 20 years, I've also done many home equity lines of credit and home equity loans for my own personal use. Some I've done through me, some I've gone outside. So I'm very well versed in it, and I'm always going to direct everybody in the right direction based on what their needs are.
Yeah, well, I definitely trust you with doing the right thing by people. So, um,
100%.
we'll be speaking off camera after this, John. Um,
Yeah.
last question, because this was another thing that I'm wondering, and these are genuinely, I'm asking because I don't know, and that's why I wanted to talk to you about this and not just
Yeah.
make up some nonsense and tell people. If you, so let's say someone, I don't know for what reason, doesn't want to take a HELOC. Obviously right now, if you have a 3% interest rate or for anything under, 6, you don't want to refinance. Is there any other way to tap into your equity in your home, besides a HELOC or a refinance?
Well, the home equity loan, right? So you have the line of credit that we just went over, that it's a revolving account, and then there's a home equity loan. So if you know that, like my cousin, for example, Nicole, we talked about this. I don't know, it was before the rates started to go really sideways, and she wanted to finish a dormer upstairs, and she knew that she needed like $75,000.
Mhm.
So using a line of credit where the rate's going to change on you, is a slippery slope, especially today. So she decided to go with a fixed rate option. It was a 20-year fix. I think at the time she got something maybe in the low sixes, if I'm not mistaken, which today ends up being it was a smart move, right? Because she
Yeah.
she avoided all the increases, but the same principle, no cost to doing it. And it's just and it gives you that stability of having that fixed rate, your monthly payment every month, just like your primary mortgage. And that could be, a way to access some cash. And then if down the road, if rates do stabilize, now you might have a rate of say 4% on your primary. You might have something about 8 or 7, or depending on what you can get. And then maybe if the rates are in the fives, in a couple of years from now, maybe you blend them together and you consolidate them into one mortgage. So that's pretty that's pretty typical, as far as what people do regarding that. Let me just see really quick here. So HELOCs, let me see if I can give you an idea of what a home equity loan would look like. So just to throw this out there, home equity loans are anywhere from, I would say, not, well, this particular bank I'm looking at is 9 to 9.75 on a 20-year.
Okay.
So yeah, so like for example, a HELOC, they have one where again, standard rate is 8.5, which is prime. They also offer like a 1-year fixed intro rate of 6.99. So it's going to fluctuate a little bit, but
Okay.
I would say anywhere between 7 and maybe 10.5 is probably where you're gonna fall, depending on what it is that you're looking for, based on your credit, based on your loan to value.
Right. Okay. I mean, this is the information I feel like that we're going to get pounded with very soon. So I'm really glad that you jumped on and really made this clear and understandable for everybody, because first thing I'm going to do is just push this to my clients who have been asking me about it, because this is the information that they need.
Okay.
So yeah, go ahead. Oh, sorry, I didn't mean to cut you
No,
off.
I got one more thing for you.
Okay.
And I think we should catch up again to discuss this one, because my company has this unique program. It's called All-in-One, and it's not for everybody,
Okay.
but it's really for the person that is cash flow positive. It's for the person who maybe has stable income, and then maybe receives commissions, bonuses, large sums of money. And what we're doing is we're essentially using like a line of credit as their primary mortgage, instead of a traditional 30-year fixed. This is really
Interesting.
crazy, but we're combining your home equity mortgage with your personal finances. So you eliminate your need for your checking, your regular checking and the savings account, and you're basically living within your home equity loan. And the idea behind it is how interest is being calculated, where a traditional mortgage, you're predominantly paying interest and it's all front loaded, right?
Right.
Whereas this type of loan, it's based on a daily average based on your interest. So here you're paying your principal first and your interest second, where the bank and the traditional mortgage, you're paying your interest first and then your principal. So for anyone that is looking for a way to accelerate principal reduction, in some models, you're looking at taking a 30-year mortgage and being able to pay it down to about 12 or 13 years by this strategy. It's incredible when you see the numbers and how awesome this really is. And if I wasn't in the position I'm in today, in terms of the back end of my loan, I'd do this all day long.
Okay, that sounds really juicy, and yeah, I could think of about 6, 7 people right now off the top of my head that would be very interested in this type of loan setup for sure.
Yeah, it is. It's incredible, because when you look at, like, we're so conditioned to think the lower the interest rate, right? That's what matters. It's really not, because in these models, the interest rates are much higher than what, let's say, a traditional mortgage is, but it's the way the interest is being calculated that will determine how much you pay.
Right.
So it's pretty ingenious. And again, especially if you have those monies in these low interest bearing accounts, there's no reason for that money to be sitting there not doing anything for you. And rather than you paying this interest, with this noose around your neck on a per 30-year mortgage, you're able to utilize it in a way where you have that flexibility constantly. So as you paying it down, you have the access to that equity to use it for whatever needs you have. So definitely something that's been around for a long time. It's my company has been doing it for about 18 years, but it hasn't been really widely pushed. And it's
The
definitely
first time I'm hearing about it, which doesn't really say much, but still.
all right. I'll tell you what I'm going to do is I'm going to send you a link to watch like a half-hour presentation on it,
Okay.
just to kind of get a little bit of an insight to it. And
Yeah.
I guarantee you're going to love it.
Yeah, that's awesome. I mean, and I'm imagining now, neither of us are CPAs, but I'm imagining that there's still some tax relief benefits to that, because you still have debt. So
Yeah.
you could still claim against that, which obviously, I mean, I know many people who want to keep a mortgage no matter how much it is, just to be able to have some debt. Yeah. So I'm imagining you could use this in a similar fashion.
Yeah, of course. It's a mortgage. It's against your house and it's interest bearing. So yeah, of
Yeah.
course.
Oh, wow. Unbelievable. Well, listen, every time I talk to you, I learn more, and I'm someone who thinks I know everything. So that's really amazing.
Well, I'm glad I can share. I'm glad I can share, and I appreciate the time today with you, my friend. You're always you're always great to talk to. Enjoy the rest of your day, and if you need anything, you know where to find me.
Hey, thank you very much. And I'm going to link all of your stuff, John, to this so people can find you. I'm going to post this whole video on YouTube so everybody's going to be able to see it. I'm actually starting a small business series. Have my first launch today, actually, first episode, where we're just going to be focusing on speaking with small business owners and how they got their business running and what they do and their marketing and what they offer specifically and how they differentiate themselves. So, you're obviously going to be a part of that, John. So
Awesome.
be ready. But yeah, I want to put all your stuff there so people can see it and just blast you out to everybody because you are just such an awesome resource.
Appreciate that. Appreciate the words, and I will send you the breakdown of the prime rate so you can post that as well. Okay.
All right. Awesome, John. Thank you.
See you, brother.
Take it easy, buddy.